All right, let's talk about the elephant in the room, the question on everyone's mind. Are we in a massive AI stock bubble? To figure that out, we're going to do something a little different. We're going to run a stress test using the .com crash as our guide. Let's see what history can teach us.
I mean, it's the question, right? Tech valuations are just through the roof, and you can't help but feel a little sense of déjà vu. The excitement around AI is absolutely electric, but, so is the fear of what might happen next.
And look, it's a totally fair question to be asking. Do you cash out now? Do you shift into safer investments? Or do you just buckle up and hope for the best? That uncertainty is real. But instead of just guessing, let's actually look at the data from the last time this happened. So this AI bubble fear, it's not just some random panic. It's really rooted in this feeling that a lot of these stocks are just fundamentally overvalued. We've all seen this movie before, and we have a pretty good idea of how it can end. The real trick is figuring out how to navigate it when it happens.
That's exactly what we're going to do. We're running a thought experiment. We are literally going to go back in time to the last huge tech bubble and see what would have happened if you had invested at the absolute worst possible moment. Okay, so picture this. The year is 1999. The internet is this shiny new thing, and tech stocks are just exploding. It feels like the party is never, ever going to stop. And our investor? They decide to go all in on tech.
We are talking about the ultimate worst-case scenario. You take a huge chunk of money, $100,000, and you dump it into the market right before the whole thing comes crashing down. Our investment vehicle is the QQQ, an ETF that's just stuffed with the biggest tech names of the day. So there we are, end of 1999, $100,000 in the market, ready to make you rich. The future looks so bright, but then the slide begins. After just 1 year, your portfolio is down by a staggering 36%. Poof, over a third of your investment is just gone. The pain is real, and it is immediate. And you think, okay, that has to be the worst of it. But it doesn't stop. The very next year, it drops another 33%. And you have to remember, these losses are compounding. We're now down almost 60% from where we started. It's brutal. And here we are, 3 years later. The bottom, that initial $100,000, is now worth a little over $26,000. That is a nearly 75% loss. This right here is the point of maximum pain, the moment where almost anyone would be tempted to just sell it all and walk away forever. But what if our investor didn't sell? What if, through all that pain and misery, they just held on? Well, this is where the story completely changes. It goes from a nightmare of loss to an incredible story of resilience. Just look at this timeline. After hitting rock bottom in 2002, the fund slowly, painfully claws its way back. It even survives another huge crash, the 2008 financial crisis. And then, by 2013, a full 14 years later, our investor is finally back to even. But hold on, because the story doesn't end there. The growth after that is just explosive. Today, that $100,000 invested at the worst possible time in history would be worth over $810,000. Just incredible. And this right here illustrates the most important lesson of all. That diversified ETF, holding a whole basket of companies, it weathered the storm and eventually soared. But what about all those individual .com stocks? Pets.com, Webvan, so many of them went to zero. They went bankrupt and never came back. This is the raw power of diversification. So, what does this blast from the past tell us about what's coming up? Let's bring it back to today and see what some of the experts are actually predicting for 2026. Let's take a look at Tom Lee from Fundstrat. He's thinking that 2026 could be a pretty turbulent year. He actually predicts a period that might look and feel like a bear market. But, and this is the important part, he thinks we'll come out of it in a really strong position. So, let's break that down. He's seeing a bumpy first half of 2026, mostly because the market is going to want to test a new Federal Reserve chair. But then he expects these things called the Fed put and the White House put to kick in as tailwinds, leading to a much stronger second half of the year. So this Fed put, what the heck is that? Well, think of it like a safety net. It's the market's belief that if things get really bad, the Federal Reserve will jump in with policies like interest rate cuts to stop a complete and total collapse. It's like an insurance policy for the market. Okay, so given that forecast, there are some really critical dates and events coming up that you're going to want to have on your radar. These are the moments that will give us the data that the Fed is going to be watching like a hawk. Now, what's really wild is just how clustered all these events are. You've got inflation reports, jobs numbers, a ton of company earnings, and then the big Fed meeting, all crammed into just a few weeks. That short little window is basically going to set the tone for the entire year. So, when you boil it all down, what's the big lesson here? It's this. A major correction in tech isn't a question of if, it's a question of when. But history teaches us a really powerful lesson. For patient investors in solid, diversified funds, riding out the storm, even a really bad one, has been the winning play. And that really leaves us with one last question to chew on. If a market downturn does hit in 2026, how are you going to look at it? Is it a risk to be terrified of? Or is it an opportunity to be seized, a chance to buy great assets when everyone else is running for the hills? History gives us a roadmap, but ultimately, that choice is yours.